Good morning. Good morning. It's Wednesday. I'm Wayne. Welcome to Wednesdays with Wayne, brought to you by the Real Estate Business School, where you get your license and learn to use it. This is the learn to use it part. Before we get started, as always, once again, I want to thank you for your time. And again, as always, you have my commitment. I'll do my best to make sure your time is well spent. So thank you for showing up. I've got the earbuds in because I'm told it's on my microphone, so bear with me. And I've got my notes to kind of keep me on track because I tend to wander sometimes. So thank you. Today, this is the learn to use it part. The wealth in real estate is in owning it, not listing it and selling it to someone else. So if you want to know more about this subject, there's several ways you can consume this information. You can go to our YouTube channel, Real Estate Business School. You can go to our website. You can purchase the book. I've written over 25. This one comes from the book, Investing 101. What is that property really worth? And it's followed by Investing 202, how to manage and mitigate risk. And so, to me, sometimes these two issues are conflated. And in my mind, they're two different things. One is value, and the other one is return. And I see them as two separate things. The first thing I'm going to do is figure out what the property's worth. Then I'll project returns, and then as time goes by, we have the data, then we'll measure the returns. So to me, they're two different subjects, so I separated them. You can also go to Wealthy Money Club, our Facebook page, Wealthy Money Club, where we have more educational pieces. There are articles, there are videos, there are opportunities. If you have equity and you want to become a passive investor, or you are a passive investor with equity, then we still got some equity opportunities. But Wealthy Money Club would be the page to go do that. And then let us know if you have any questions. Anytime, always, email me. You can email me info@buildmyrebusiness.com. And happy to take your, or you can call us, 800-624-5440. We'll take your calls, we'll take your emails, so get them over to me, and we'll get back to you. So thank you for your time. Thanks for showing up. There's a difference between sales price and value. And we've been reviewing over the past several sessions, because real estate investing is a really hot topic here recently. We've been going over ways to determine the value of property and determine it, and then we want to project ROI and then measure ROI over time, as I just said. So we went through the valuations and how to value property. Then we went into some ROI calculations. And to me, ROI has a couple different meanings. A lot of people use it only one way. To me, it means two things. One is return of the investment, and the other is return on the investment. And there have been some deals I've been in where I really didn't care about the return on my investment. I just wanted my money back. I just want the return of my money. And if you've been in those deals, you know what I'm talking about. Also want to give a shout out to Katrina Mustard Yellow, honey. She dared me to wear them. Also to Jesse Guzman, if you're watching, thanks for showing up. But we went into ROI, return of, return on. And then we did some calculations on return on. One was cash on cash. And then we showed the definition, the meaning, the calculations on what cash on cash tells us. And then we did the T-bar to show the 5 pieces of information you need to calculate. And you can go review that, but it's the initial investment or present value, the cash flows in or out, the future value, the time, and then the interest or yield on the investment. So if you get either of the 4, you can get the 5th one. That's also in video. You can go watch that one for a review. And then we went into IRR, internal rate of return. We defined that, we showed some examples, and we told everybody what that means. Now, today, we're on to cap rate. So, cap rates, how's that? My producer said to move this over. Is that better?
I don't know.
So thank good producer when you see her. If you see her. Cap rates. What's cap rate? Well, it's short for capitalization rate. And so the capitalization rate is simply the amount of income that the property throws off, the NOI. It's using the NOI as a tool to determine the value of the property. And the rate is the amount it takes to get the net present, it is used to calculate the net present value. If you're buying the property today, we want to know the value today. So a cap rate will tell us that. So a cap rate will tell us value and it will tell us returns. Actually, it's going to tell us four things. But it's the only one that does that. Most of these other calculations are either return of investment, they tell us value, or they return on investment. They tell us what our returns on the money is. So basically, what we're doing here in a nutshell is we're giving a value to an income stream. It's represented by the sticks and bricks, but we're buying future income with present dollars. Right? I mean, that's what holds value in commercial property. In residential, you determine value two ways. Right? It's either a CMA, a comparable market analysis, or an appraisal. Appraisal is a little more complicated, but basically, and it takes a different license, but usually the common denominator between the appraisal and the comparable market analysis are sold comparables, because the definition of fair market value is what a property will sell for, with a willing buyer, qualified buyer, a willing seller need to be under duress. That's basically the definition. So sold comps, active properties, what people are asking doesn't tell you market value. Expired listings tell you they're overpriced and undermarketed. That's what that tells you. But the sold properties tell us an indication of value. Now we get a range. We don't know the exact price they're going to trade at, but we have a range now. In commercial, it's different. It's income stream. So how do you take current money and buy future money, and what's the value, and how does all this work? So that's what we're going to go into. So a cap rate is a ratio of income to the value of the investment. And we'll show how that works. So they kind of work like this. If you had, say, $1 million CD, and it was throwing off $50,000 a month, then you have got $1 million in a CD. And it's paying you 5% a year. It's paying you $50,000. Or you can work it this way. If you needed $50,000 per year, then you divide 50,000 by the million, you'll get 5%. Either way, you can calculate either what you're going to make or what you're going to need to make it. So you can put value on the $1 million, and if the bank says the value is 5%, you can calculate what your return's going to be. If you have this and the million, and you know you're making 50,000, then you can calculate and figure out what your return is, interest rate you're getting paid. Well, a cap rate works the same thing. What you're going to have when you look at these pro formas, and by the way, when you look at it, just remember, you can usually take about 20% off the income. They're typically not performing that well, and you can usually add about 20% to the expenses because they're not that low. Then you'll get within 10 or 15%. This is why you see the disclaimers at the bottom of them that say information deemed reliable but not guaranteed. So that's how you calculate. And just to give you an example, let's say that, and this comes from the book Investing 101. This is the chapter Commercial Real Estate Methods, APOD, NOI, cap rates, and GRMs. So when it comes to value, in its basic terms, a property's value is defined as the current worth of the potential future financial benefits measured by the projected sum of all the income streams. The future benefit measured by the projected sum of all the current net income streams. In opposition to, like, you have this immediate consumable goods, right? Like paper, jumbo markers, chocolate, Twinkies, paint, cars, consumables that provide benefits immediately. But real property assets tend to provide benefits over a longer period of time. So we've got to measure that, sometimes years, sometimes decades. It depends on your hold. Additionally, income producing real estate is typically purchased as an investment, and the earning power of that investment is critical to making a decision whether or not to purchase it and to be used in an analysis process. What is its earning power? And this is why I stopped working with buyers early in my residential real estate career a few decades ago. It's because they could see the home the way it was, not the way it could be. Same way with real estate investors. They see what it is. Some have trouble seeing what it can be. And the goal here, the art, is to see not just what it is, but what it can be. This is what's so fun about developing. So we're in 2 projects now, about $80 million worth of investment. Not big deals, but we do small infill projects where we're really too big for the 2A infomercial wannabe guys, but we're too small for the real developers. We just do these little infill projects where there's not much competition. So, but it's fun to take a piece of raw land, see what could be there, learning all the rules and regulations, and then getting in compliance with those, getting the city to love your project, and getting people to want to go design it and build it and all that for you. So it's this vision of seeing what the property can be. Same thing with investment. You see a piece of property out there that's for sale, you see it as it is, but can you see what it can be? And part of the analysis is giving you the tools to see what it can be. And yes, they're all projections, and yes, sometimes they're wrong, but a lot of times they're right, and they're more right than they are wrong. That's why people invest. So in this section, we're going to do our best to say how you explain and capitalize that income stream, and how do you use the income to determine the property value today. Okay? Because the investment properties, and I'll just read this some more, that produce income, and that income has value. But please remember, each investment is unique to each investor. And that income stream is going to have a different value depending on who the investor is and what their goals and criteria are. So here's how we go about doing this. We're going to use a capitalization approach to use. This is done in 3 steps. First, we complete the APOD form, then we determine the cap rate, and then we determine the net operating income, then the cap rate, then divide the cap rate by NOI, and then we'll arrive at the property value. And so when you look at an APOD form, and I've got one right here you can see, but your business should have a P&L. So this is the APOD that we're going to be using as an example. Hopefully you can see this. So it's a small property, it's 12 units, West Campus. It was one that we owned years ago. So I decided to use this example because I'm vaguely familiar with it. So when you have a business financial statement, you've got gross revenue, cost of goods, gross profit, expenses, net profit. The APOD form, Annual Property Operating Data, is what that stands for, APOD, Annual Property Operating Data. It tells you the same thing. It's the P&L for the property. So sometimes you get a projection It's a pro forma that's built by the listing agent, typically as a marketing tool to help the wannabe buyer, prospective buyer, make a decision. But when you go into your due diligence period, you'll want to get tax returns. The seller may fudge some numbers when they're giving them to the listing agent to pass on to you. Listing agent may bend one here and there or miss one inadvertently. They won't lie on their taxes. So part of this due diligence is tax returns to make sure that those are the numbers. So you're going to have, again, and these are 7 things you're going to have here. One is the gross potential income. And then the second one you're going to have is vacancy and credit losses. The units are going to go vacant. If you own multifamily, you're going to have vacancies. Credit loss is they signed a lease and they didn't pay for it. They didn't make their payments. They got mad when you asked for them. They didn't pay the rent. They got upset with you when you asked them for their rent. Then they trashed it on the way out in the middle of the night. So those are credit losses. Third thing is you're going to have your effective rental income. Number 4, you're going to have other income. This is going to come from vending, other services, parking, whatever. 5, then you have your gross operating income. This is a fairly common used acronym, GOI. And 6, you're going to have expenses. And then 7, just like your other P&L for your business, that shows net profit or loss, you have your net operating income. That's what's on your pro forma. That's what's on your APOD form. So when I approach a property, the first thing I'm going to do is determine the value, and then I'm determining what I feel the projected returns might be. So how do we use this information? And what do we do with this? Well, just like a business or your personal P&L or anything else, this is the golden number here. How much is left? And the way to get that is the way you get anything else up. You get your income, you have to get income up and expenses down, or a combination of the two. So what we're looking for, as we talked about before, is what I'm looking for. And this is why I don't pay fair market value, because fair market value has that little caveat in there, neither being under duress. I want duress. I'm looking for a problem property with a problem seller. And you put the two together and you have an opportunity. So the goal here is to solve a problem someone else has. And the bigger the problem, the bigger the check. So if you can approach it from that point of view, then you can go start looking at this APOD and see what the opportunity might be. So we've got these categories, and let's explore how cap rates affect value. So when I wrote the book, I finished this one a couple of years ago. Cap rates were in the 3 and 4% range for multifamily in Central Texas. So we got to figure out what we're going to do to find the value of this property. So in this one, I'm going to write this on here. The gross projected income. You'll get projected if it's probably a value-add property, fixer-upper. If it's currently in pretty good shape, they'll just use projected, or they'll just use gross rental income. But this was $72,000. And then the vacancy and credit losses, we used 5%. So that was $3,600. So our effective rental income became, I hope you can see over this. This was kind of impromptu. I just had to write this on it so you could see it. $68,400. There was some other income, parking and laundry on this one. So other was, we got the 3,600 back. So that came in handy. So our GOI again was back to 72,000. The expenses on this were kind of low. They're only 25.4. And so our NOI on this property ended up being around $46,000, 46.6. So, if you, what's the value of this property? Well, it depends. What are your investing criteria? I mean, would you pay a premium to have a 12-unit multifamily building 2 blocks from the University of Texas? Probably. If you could acquire one of those that had leases in place were year-long leases, not just for the school period, so you got paid even when they were vacant during the summer, would that increase the value? Probably yes. Well, what if you had that property on a triple net lease like a commercial property? And even though people say you can't do that, you can because they did it. So don't listen to other people who tell you what you can't do. What if you had it on a triple net lease where the tenants had a fairly below market rate, but they paid any bumps in taxes and insurance and they paid the maintenance? Well, we know who that demographic is, right? That's 18 to 20, I don't know, 5-year-olds, depends on their learning speed. They're slow learners, they may be 30 and still haven't been there. Whatever. What if we had every one of their parents on a personal guarantee, not just for the pro rata share, not just for their kids' share, but for the whole amount? So you start layering these things, and what happens is these are things that are intrinsic to the deal, but not really physical attributes, but they add value to the property because it lowers risk. Anytime you can lower risk, in my mind, you're adding value. So this is the way we structured this deal. So you have 46.6 here. I'm going to stay on track here. That story wasn't in my script, but I thought it was a good one. That's true, we did this. It was amazing. So we had them rented year long, and had really good, strong credit tenants. Their parents, strong, guaranteed. And everything that they told us we couldn't do, we did, and the property became, one of the things that we did were really successful. We paid $90 for this thing in the recession in 1989, and we sold it for $900,000 20 years later. Looking back, I probably should have kept it. I should have refinanced and pulled some cash out, but I didn't know how to do that then. Anyway, it's interesting. I drove by there last year. The building's gone. They're building a huge tower there. I could have done that. Anyway, I'm off script again. So let's say that you get this pro forma and you or your client looking for something in West Campus near a major university. You decide it's the University of Texas. You go, okay, well look, here's this property. It's doing okay. It's got a $46,000 NOI. What should we pay for this, and what's the value to us? And so, if the market says 4 to 5% cap rates, 4 to 5 capitalization rates, and you can find this by calling almost any broker in any city. I mean, you could call one of your national brokers, Marcus and Millichap, Coldwell Banker, one of the national chains. You call a broker in Atlanta and go, what's multifamily doing in Buckhead? They go, that's 4 to 5. What's happening in Dallas-Fort Worth? What's 3 to 4? What's happening in anywhere? So it's a terminology that brokers can use to kind of get in a range of values. And as you get into the weeds, this may change, but it gives us good indication about what the market's doing. Because again, cap rates tell us 4 things. They'll tell you what they are. But one is value. Another one's going to tell you is what the price should be, because They're related. So if you had a, let's say, market's 4%, 4 cap. So you take your 46.6 and you divide it by 4%, 0.04, and you should get 1,165,000. That's the value if you're a 4 cap. If you have an investor that is willing to pay 4% cap rates for multifamily West Campus, this is their criteria. Let's say that same investor says, no, you know what? I think that's kind of risky. I'm really not going to do anything below 5. I'm a 5 or better buyer. Then you've got to take that same $46,600 divided by 0.05 and give you the new value, which is $932,000. And so, as you do these calculations, you'll see an interesting pattern develop. So 46.6 at 4 is 1,165. The same at 5 is 932. What if your client says, you know what, I'm just not going to do that, but I'll do it at 6. So your 46.6, here's your calculators, and calculate this with me. 46,600 NOI at a 6% cap rate. And you can see what this buyer is willing to pay. And so now we're at what? 776.6? 776,667. 6, 7. I said, that's way too risky. I'm a 7 cap buyer. Okay, well, that's probably unreasonable, but we'll calculate it. 665, 7. There it. 665, 714. So now you can see and start to get a feeling for how cap rates affect value. I mean, you get that thing down to a 8 cap, it's 582.5. And so, for one investor, their criteria, West Campus, multifamily, 8 cap, this is what the value is to them. This is what the value is to them. This is value, that's value, that's value. Now, I'm not saying they're going to buy it for that. I'm just saying this is their criteria. So once you know this, and you start looking for properties that meet their criteria, you go, look, I can't do that, but what if I could do this? And you can do this, and you can do that. You start giving them options. And you show them how they can make that deal fit. So this is how you use cap rates. So typically, this is where it starts getting interesting. These high cap rates, it's like a low price in residential. They tend to be distressed fixer-uppers. Now, if you like buying distressed and rehabbing them and putting strong tenants in there, getting that NOI up, getting them stabilized and reselling them, then this is the way to go. And some investors enjoy doing that. Some say, you know what, I don't care. I don't want to rehab. I don't want to get contractors. I don't want to go through that. Supply chains are still not back in place. Prices are difficult to predict. I just don't know what's really going to cost me. Labor prices are up and down. I don't know what labor's going to cost me. I don't know if we even have enough labor. So I really don't want to do a fixer-upper in this market. I'd rather just buy one that's done and ready to go. I'm maybe paying a premium, but that's my criteria. I don't want to do this. So either way is fine, and either way works. The thing is, what are your criteria? And I have someone in my investing class Said, I've got, $50,000. What should I buy? I said, do you know how to calculate a cash and cash return? No. Do you know how to calculate an IRR? What's IRR? Okay, great question. What I suggest you do is take a class. So tomorrow in class, we're going to go over IRR and cash on cash and cap rates. And by the end of this class, you'll know the answers to all those questions. And then you'll have your own criteria. So the first thing I would do is go find out how do you figure out what these returns are? How do you use them? What did they tell you? Because they're going to tell you if this investment fits your criteria or not. Okay, so let's do this just a little bit more. The thing is, if you notice you have a pattern here, as cap rates go up, property values go down. So what we know is that the lower the cap rate, the higher the price. The higher the cap rate, the lower the price. So, if you look at this, you can see a pattern. And if you can acquire this here and sell it here, so now your formula could be buying a 7, selling a 5, buying an 8, selling a 6, buying a 6, selling a 4. So if you were to calculate this, you could say, well, I could pick it up at a 6 and sell it for 4, but it's going to cost me $250 to do it. Well, let's calculate that. So if you buy it on a 6, that's and sell on a 4. So 1165 minus 776,667. That's $388,000. It's going to cost you $150 to fix it up. It's $150,000 off. $238. That's your potential gain. Okay, let's say it's only half that. Now, are you interested? And so when I say you got to have your own criteria, this is what I'm talking about. I mean, at what point do you lose interest? Because I'm going totally off script now if I just had this thought. There's something that is in each and every investment that most people don't talk about. But I've experienced it multiple times. This is what I call it. Okay? It's the frustration factor. And so if your yield or your return is through the roof, and so is your frustration factor, the question is, was that worth it? But sometimes I look at these and I went, okay, we knocked it out of the park, but that was way too hard. And there are times I'm like, okay, look, I get this may come down, but this needs to get down. I got so much capacity for this stuff. I mean, if one more person brings me a problem, I mean, the motto in the company is, if you have a problem, bring a solution. See, if you have the problem, you probably know what the solution is. Stop bringing the problems. Just bring a solution. Let's talk about how we're going to fix it. Don't tell me how broken it is. I'm looking at it. I can tell. I know what I'm talking about, right? So this is something you got to calculate in here. And at some point in between these numbers, between 250,000 and 150,000, the frustration factor's got to be calculated. You got to put that in there, right? And how hard is this going to be? Well, it's going to be really, really hard. Nah. And now we talked about, we get to the thing we talked about last week, which is opportunity cost. That's when you have A or B. And you choose A and B outperforms it. The delta is your opportunity cost. You could have made that much and you made that much. You could have done that, but you did that. The difference there, that 100,000 is your opportunity cost. The problem is you never know it until after the fact. I'll just give you information. You got to decide. Good luck out there. But I hope this makes sense, right? I mean, you can see the pattern, right? So we'll move along. Let's say that. Oh yeah, if you have the other information, you can still come up with the same solution. Like for example, right here. Let's say that all you know is sales price and NOI. So you have 1165 is the asking price for this property, and the NOI is 46.6. Well, how do you calculate that? So take the 46.6 there it is. Take the 46.6 NOI divided by your sales price, and it's going to give you the cap rate, which is we know you're going to see this. So you multiply it times 100, and you get 4. So you can do that on every one of these. So you have 46.6 and a 932,000, so 932 divided by 46.6. What are you going to get? You're going to get 5. 5 cap, 4 cap. What's the next one? You have 46.6 divided by 776. 776, 667 by 46.6 is going to be 6%. And you can see the next one, 665, 5714 divided by the NOI is going to be 7%. And on you go. So whichever one you have, you can do the other. If you got the NOI and you got the preferred cap rate or your desired cap rate, you can get the value. And if all you did on the pro forma is the sales price and NOI, you can come to your own cap rate. So I hope that helps. And then cap rate, as we know, is going to tell us, just remember, each property is unique to each investor. And the buying and selling criteria are going to vary. That's why I think it's imperative to ask these questions. And this is what I want to know before I go in. It's, first of all, my first question is, why are they selling? It's amazing how many people will tell you when you ask them. It's a good thing to know. But also, what's the economy doing in your area? Because it's still geographic. There are parts of this country you don't want to own multifamily in. There are parts of the country you don't want to own office buildings in. What's the economy doing in your area? And what are the different sectors doing in your area? What we know is we're still feeling the results of COVID. Office vacancies, according to Austin Business Journal and other reputable publications, are at 70%. I mean, Amazon just built a huge office, they're not going to occupy it. Home Depot built a huge office, they're not going to occupy it. Indeed built a building, they didn't build an office, I'm sorry. They weren't offices they built, they were buildings they built that they're not going to occupy. Facebook built it, but they're not going to occupy it. They leased it, they're not going to occupy it. And so there's this big debate about whether working remotely increases productivity. Some say it does, some say it doesn't. Some say I want people back in the office, I want to watch them work. Productivity is low, I don't know how they're measuring that. We have a way to do it. We watch it. Well, I'm okay with ours for now. Point is, when you don't have that, you've got those offices, you've got those buildings, you got those leases coming due. The question is, are these business owners, these businesses going to renew leases in office buildings their employees won't go to? I think the answer is fairly obvious. That would be no, Bob. So what happens to the value of that building when it's all income driven? Obviously it drops. So probably not. So what are cap rates doing with office space right now? Oh, they're creeping up a little bit. What's also losing some values, some luster? Multifamily. Multifamily was the hottest thing since sliced bread. And they were doing great. And what happened? Well, with multifamily, you don't have long-term interest rates, the short term. And when that loan terminates, it's got to be renewed. Well, it gets renewed at a different rate, and the rate's higher than it was before. Sometimes almost double, sometimes almost triple. Well, what does that do to cash flows? It crushes them. It dings them. It reduces them. How much, how many, I don't know. But we know it's having an effect. What's happening to retail? Retail's rebounded, much to most people's surprise. Retail's doing great. So multifamily, man, it's hit and miss. They're still hanging at 4 and 5%, but it's not 3 and 4. I asked a friend of mine, this guy's a stud and one of the top multifamily brokers in the country. I said, who would pay 3% cap rates for these multifamily properties? I mean, what's the criteria? What's the thinking behind that? Help me understand why someone would pay that much over market. Was that over market for this property? I mean, Greg's a smart guy. He says, well, it's all based on future rental growth. Future rent growth. They're willing to pay a premium now for future rent growth. They see Central Texas as a place to be decades from now. It's coming this way. It's not going to stop. It's ongoing. There'll be fluctuations, but it's coming. Oh, that's great information. So the real smart people with real money are buying. Yeah. And demand's through the roof. So there you go. So now it helps us understand who would pay these and why and what their criteria are. So, what's happening in the area overall? And this was someone asked me last year, so why are you developing in a bubble? I'm like, it's not a bubble. These are real companies with real people, with real jobs who want real houses that don't exist. There's demand out there that hasn't been met. And so, we're back to our old friend. It's Economics 101. I know I've shown you this before, but I'm doing it again. It's this. And what we know is the supply for housing is still low. The demand is high, and what follows demand? Price. So yeah, there's been a stall in single family because interest rates tripled. Some buyers on fixed incomes were priced out of the market, but the market overall is good. Look, we went from 2 weeks to 2 months. The seller's market equilibrium is 6. It's still a seller's market. Are they sitting on the market longer? Yes, people are taking longer to make a decision. And from the bottom to the middle to the high end, they've all been affected. But the demand is still there. And that's what gives me confidence, is this unrelenting demand. Texas is now called the headquarters for headquarters, according to the economic advisor for the state of Texas, Governor Greg Abbott's economic advisor. She spoke at the commercial real estate conference we did a couple weeks ago that I attended, and she did a great presentation. 238 corporate offices have moved here since, I think it was 2010. Anyway, they're relocating to Texas because of the economy and lots of other things that they find attractive. Low prices compared to some of those states, better housing, lots of diversity, and everything you'd want: safety, security, business opportunities, opportunity everywhere. So when I start to make a decision about deploying capital, then these are the things I look at. It's micro and macro. So what we're doing again is we're buying this. We're taking this and we're buying this. We're taking money, we're buying money. We're buying an income stream. It's represented by, I know, these sticks and bricks. I get it. Yeah. Whatever it is. Offices, office, multifamily, whatever it is, it's represented by the sticks and bricks, but we're buying an income stream when we're buying commercial property. So we're taking present value dollars and we're buying future value dollars, represented by this income stream, also known as cash flow. The C word and the F word, two most important four-letter words in the English language. So the question is, what is it worth? Where does this come from? Well, typically this is your equity, and then this over here is your debt. So you take this bucket, and you take this bucket, and you equal this acquisition. So if you don't have equity, then you go find investors. You don't need money. I keep hearing people say, I say, why don't you invest? I don't have money. Why don't you invest? I don't have credit. You don't need money or credit. What you need is the deal. If you have the deal, because there's a lot of investors looking for deals. If you have the deals in financial education, well, first of all, you'd have money and credit. But if you don't have money and credit, but you have a financial education, then all you need is a deal, because there's equity out there looking for deals. And there's banks out there still lending. So you acquire the property, and then you rehab or you build, whatever it is. You put a tenant in there. The tenant pays back the debt. You put this tenant on a triple net lease, which means they pay the taxes, insurance, and maintenance. You put them on a 5-year hold. In 5 years, you sell it. You pay back the debt. You pay back the equity investors. Then you pay them back a preferred return on their money. And so then you have these buckets. You pay that off, pay that off. You got this bucket of cash left that belongs to you. That's how you put those deals together. So what do cap rates tell us? Well, to help us make this decision whether to purchase or not, first of all, they tell us demand. When you see cap rates doing this and lower, 4% and less, this is what I see. Low supply, high demand. When prices are going up, demand is going up. So it tells us demand. It also tells us value, the value to the investor. And each investment is unique to each investor, and all going to be different. It also tells you risk. This is the interesting part of this conversation. Some people say that this is a risky investment. 8% cap rate, 7%, they're risky, they're distressed, they're a mess, they're risky. Other people say, look, these guys are paying a premium at the top of the market. If the market corrects, they're going to be underwater. They're the ones taking the risk. So which one's risky? The answer is it depends. Another answer is both. It's all a point of view. Getting rich is a choice. It's a point of view. Beauty is a point of view. Investments are a point of view. And so again, to beat this horse to death, you got to have your own criteria. And if you don't know enough or have enough experience to set your own criteria, do something. Because if you save money, you lose it. So we've got to invest in something. So put it in something, but start small. Like I said, my first investment was a condo. And look, unfortunately, I did okay. I think if I'd have gotten my hat handed to me, I probably may not have done another one. But the second one we did was at 16 units west of campus, and we've been buying and doing this ever since. And you learn something on every deal, and they're all fun, they're all great. It just depends. And the point is, these judgmental terms, is good, is it bad, is it this, it's all, the answer is it depends. It depends on you, it depends your level of knowledge, your level of experience, your tolerance for risk. If you're younger, in your 20s, put it out there. You gotta get started though. Once you crack 50, y'all that if you're watching and haven't started, it's kind of late to become a tree farmer. You gotta get going. So this is what I look for. So it tells you demand, value, risk, and it tells you the return if you pay cash. So it tells you value and ROI. It's the only one that does it, cap rates. So demand, that's it. So they affect risk. The point is, say the lower the cap rate, the higher price. To me, the higher the risk. Someone's parking cash and waiting for long term. So keep in mind that financing isn't long term, it's short term. You got to calculate that into your investment. And again, if you pay too much or borrow too much, there's nothing anyone can do for you. But these fluctuations in the economy should not affect your long-term investment goals. Remember, this is the difference between a speculator and investor. Investors are in it, they know what to do, and they're in it for the long haul. It's long-term, that's investing. Speculating is not long-term, it's short-term. Okay, that's it. Wayne Morgan, Real Estate Business School, where you get your license and learn to use it. Ladies and gentlemen, this is the learn to use it part. How do you increase your financial IQ? By knowing your numbers. How do you get extraordinary, outrageous, above market returns while mitigating risk? You know what you're doing when your money's made at the closing table, not later down the road when you get it all done. It's made when the deal's done. Just like residential real estate. When is the listing sold? The night it's taken. You take that thing at 20% over market, appointment only, open every other Thursday on a full moon, no access, you can't find a lockbox, no one knows where it is, you don't market, the thing's gonna sit there. The listing sold the night it's taken. The property sold the day it's closed on. Your profits made at closing. Yeah? Okay. Good luck. Email me if you have any questions. Real Estate Business School, where you can take these TREC-approved courses. If you have CE coming up, or continuing education requirements coming up, you want to take something educational about investing, we've got 2-hour courses and 4-hour courses about investing. This is online, it was recorded, it's fairly entertaining, and you can stop and rewind and pause and repeat if you like. Like to me, someone's got to hear things 2 or 3 times before they sink in. You can do that. Go to Wealthy Money. These are TREC approved. You get credit. If you're not licensed and you're not going to get licensed, and you want the information, you can buy the book or you can buy the courses. We don't care if you're licensed or not. We just want to educate you so you can make better decisions going forward. And then go to Wealthy Money Club, like the page, join the page, connect on the page. If you want something more on that page that's not on that page, let us know. We'll put it on that page. So whatever we can do to support you in your journey, let us know. That's it. Email me, info@buildmyrebusiness.com, or call us at 800-624-5440. This is Wednesday. I'm Wayne. This is the session, Cap Rates. Thank you for showing up. I hope you found your time well spent, and I'll see you next Wednesday. Thank you.